That sounds like
All right, awesome. So Primerica, so tonight's training is going to be on Primerica Term Life. It says part one. And as I was saying, it's really important to know your craft, know your product that you're going to be helping people with. There's competition out there, so they're definitely going to be on the offensive. So you need to know what we have and what other companies have and how it compares. Here's a nice fact. There's a 773 life insurance companies in the U.S. Back when Art started the company, there was over 1,000, maybe like 2,000. So you've seen how it kind of has retracted. There's less now and than there were back then. But of the 773 companies that sell insurance, life insurance in the U.S., 772 of them offer cash value and term. Only one offers exclusively term insurance.
Mhm.
So why is that important? Because that means that we do what's right 100% of the time. It's not even an option. Like we don't even offer that as an option, right? Which I think is good. Um, so having known that, cash value insurance pays way more commissions in term, as we know, and that's a fact, right? So that's why a lot of these companies they'll push cash value insurance. And if cash value was better for our clients and we could earn more money selling it, why wouldn't we sell it? Okay, because people they work and they want to make money, and we are either stupid and don't know how to calculate compensation, or we do what's right 100% of the time because we know the truth and believe that the truth is more important than money. I hear Ace say that like last week he said that, right?
Yep.
Either we're stupid and we we don't know how to calculate, or there's a higher calling. And I think that our company really attracts people that are focused on the right thing. Um, I've had family members be like, "Why don't you sell cash value life insurance? You can make a lot more money." It's like, because I wouldn't be able to sleep at night if I sold that kind of stuff because I know how horrible it is, right? Um, so about Primerica, here's a couple of facts about Primerica. We're listed in the New York Stock Exchange as most of you, I would assume, know. We have about 5.7 million lives insured through our companies, including National Benefit Life up in New York and Primerica Canada. 2.7 million client investment accounts. We pay about 91% of our claims within 14 days of the claim. I've seen companies that they drag their feet and they take 4, 5, 6, 7 months to pay out. $903 billion of term life insurance in force. And on average, we pay about $9.61 million in death claims every day. And lastly, investment clients have more than 97 billion in assets with us that they've given us to invest for them. The most exciting part of these numbers, guys, when I saw this, it was okay, we've had a lot of success. We have millions of people that we've helped. But even, despite the fact that we've had a lot of success, we've been around for a long time. When I see 5.7 million lives insured and 2.7 million client investment accounts, that's exciting because just in the United States alone, there's 300 million people, right? In Canada, I think there's about 32 million people. So what does that mean, right? If you're getting into our business, the train has not left you, right? There's a lot of work still yet to be done despite all the success that we've had, right? Isn't that reassuring?
Yeah.
Investors Business Daily, which is an independent financial research company, actually has named us as one of the most trusted financial companies back in 2022, which is pretty recently. Number one most trusted life insurance company, and number three most trusted financial company. Okay, how important is credibility, guys? Is that pretty important to be a part of a company that has strong credibility? Yes,
Yes.
no? Yeah, it's pretty
Yes.
important, right? These are things that you can point out to people, leave with people when you meet with them, right? Some of these materials are available that you can leave. And check this out. It says Primerica was named as one of America's 50 most trustworthy financial companies by Forbes in 2015. Okay. Um, how many of you guys remember the financial meltdown that happened back in like 2007 and 8? A lot of bad things happened back then, right? A lot of banks were investing in very risky type of investments. And then the economy as a whole, was really affected. A lot of average and ordinary people were really affected by that stuff. So what happened to people's trust level with banks and investment and insurance companies? It was pretty low, right? So Forbes, they did this study with where they looked at key factors like risk factors. Where are these companies investing the money? How much money do they have in reserves, right? And basically what they found is that they had like the highest score in terms of financial strength was 100, which would be like perfect. And Primerica actually had the highest, along with a couple of other companies with a 99. Okay. So how assuring is that, right? I mean, we may be kind of like vanilla and plain, but we're gonna make sure that we stand behind our promises. Okay. Um, and here Forbes 2022 again named as one of America's best insurance companies. So when somebody comes and tells you, your company doesn't pay out, oh yeah, according to who? According to somebody on Reddit in Colorado in somebody's basement. I mean, why don't we look at what Forbes has to say? Investors Daily. Okay, is that a little bit more credible? A couple more, right? Forbes 2022 America's Best Insurance Companies again, right? Every year they have this independent comparative report. And this is a company that looks at insurance companies' financial strength. They don't sell insurance. They're not affiliated with any insurance companies, but they take a look at, insurance companies' financials and they do a comparison. Kind of like when we sit down with a client and we take a look at their existing plans and we do a comparison to see, are you in a good situation or can we do something better for you? And these are some of the highlights that they came up with. So they have like key indicators like solvency, liquid assets, what kind of investment returns these companies have on the monies that they receive and they invest. And bottom line is when you take a look at the numbers in black and when you take a look at the numbers in, I guess we would call that orange. Primerica is above the average numbers, right? So in terms of solvency, the average of the 25 leading insurance companies, they have about, for every $100 of liabilities, they have on average about $107 in assets to cover those liabilities. And Primerica's assets are at 150 for every 100. You can see that down there. And then at the very bottom right side, let me just doodle on this. The total assets that our company has is north of $2.3 billion in assets. You see that? And our total liabilities are 1.5, which gives us a gross surplus of about 781 million. Okay. Like for those of you who have done financial needs analysis, most people are in the red, right? They have like $200,000 or they have like a 500,000 in liabilities and they only have maybe like 100,000 in assets, right? So they're in the red. So our company, we're in the green, right? We have enough money to cover any kind of emergencies and any kind of losses. So you will have people that'll ask you, so what's going to happen if this company ever goes bankrupt? Right? I mean, there is a possibility. There's nothing is permanent, nothing is forever. But if you take a look at the leading insurance companies in America, we're sitting in a pretty solid situation, which is also very reassuring, right? Let's see, and this is kind of zoomed in, right? What you just saw there. Now, Um, we're going to take a look at three options when it comes to end of term, because we're not the only company that does term insurance. There's other companies out there that do term insurance, and you have to know how we compare to the other insurance companies. And we're going to talk specifically about, okay, when it gets to the end of the term, what are the options that the client has? And you have a couple of different options. You have something called an annual increasing premium to age 100. There's a decreasing term to age 100. And then they're constantly changing their options around. So there might be something else that comes along later. But the most important part of our end of term option is that it doesn't require any kind of evidence of reinsurability. You guys know what that means? Well,
Yeah.
who doesn't know what evidence of insurability means? Does anybody not know what that means? Or is everybody knows? Okay. So check this out. This is a policy with not with us. This is another company. And it is, as you can see here, this is a 39-year-old male. They have a total coverage of $500,000, and it's a 30-year level premium. Can anybody see what the monthly premium is here? You guys see that?
21.
What's the monthly?
$53.65.
53 and 60. So let's say that this is a client that you're going to run into, right? So I'm sitting down with Deepak. He's 39-year-old male. He has $500,000. I don't need insurance, Hector. I already have insurance with this incredible company called Legal and General of America. I have 500,000. It's only $54. It's a term insurance, right? So what do you do? Well, let's take a look at always take a look at the the renewal rates at the end, right? So as you can see here on the left-hand side, this is year 1 through 30, and that policy is going to be $631 a year, which is the $53 that we discussed. But then at the renewal, it goes from $53 to about $600 a month. And it goes from 500,000 in coverage to 125,000. So it's a 75% decrease in protection, Deepak, and it's 11.5 times more than what you're paying, which is essentially a 46% increase, because you can't even keep the same coverage. It went down to 125 for a lot more money.
Sad.
How do you feel about that renewal option?
Not good.
Not good. Not
Nope.
good, right? You think you're going to be able to afford $600 a month plus?
Nope.
Maybe not. Probably not, right? Things are getting expensive. Check this out. These are their conversion options, okay? And it says that the policy can be converted to a new policy. Evidence of insured's insurability is not required. But look at number 5. You say 1, 2, 3, 4, 5. It says no conversion shall occur while the insured is totally disabled under the terms of a total disability benefit. So what does that mean? Let's say that Ida got this 30 years ago, and then she's coming up on the end of the term, and she got a stroke. She's totally disabled. She can't work. And you know what the bold print giveth, the fine print taketh away, right? So right there it says like, well, sorry, Ida, you have a total disability. You won't qualify for another option. You basically lose your coverage. How does that sound? Does that sound good?
Terrible.
Not good.
Not good.
Right. Now with our policy, guess what? That doesn't happen, right? So we'll get into those specifics in a minute. Now here's Primerica versus the competition. Now, for those of you who have been around for a little bit, we used to have something called a custom advantage plan, and they changed it over to the next gen. So this is how our insurance. This is a 35-year-old, no, 43-year-old female that has a 35-year term for 250,000. The old Primerica Custom would have been $55.58. The new next gen product is actually going to be 3646. And if you take a look at Banner, which is one of our competitors, it's 3831. So even when you so yes, the change has been more beneficial, right? Because now the rates are lower. But when you compare it to other companies, also, we have lower rates, right? And that's the ideal situation when you run into somebody that has term and we beat them up front. That's ideal. It doesn't always happen that way, but we'll talk about this coming up. Now, a lot of us are here in the DC metro area, so we're going to run into people that have federal insurance, something called FEGLI. So I think it stands for Federal Employee Government Insurance. And so you might run into somebody, and I already have insurance through my job. I'm with the government. I pay very cheap. You can see right here they have $500,000 in coverage, and they're paying about $23.87 every pay period. And most people they get paid about twice a week, right? So, you're looking at about $50 for $500,000 for a 40-year-old. You see that? And how many of you have not seen FEGLI or don't know how FEGLI works? Everybody here has seen FEGLI?
No, there's a lot that raise their hand.
I haven't.
Okay, awesome. So let's do something because I'm not seeing my screen. So if I ask you guys a question, just chime in. Okay, so check this out. This is kind of a detailed example of what FEGLI. If you go to fegli.gov, there's a calculator. You can type in what the person makes, and that's their base pay, and then it spits out these numbers, right? So let's say that they spit out these numbers. This person has insurance, which is the basic insurance is 77,000. And correct me if I'm wrong, Allison. That's usually what their annual pay is, right? The basic. It's like
Yeah,
one
that's
time.
correct. One time their salary.
One time of the salary.
So that's 70. So this person is 40 years old. They make 77,000 a year, and then they have some extra benefit of 38,500. So that takes their total basic coverage to 115,500. And then they have a standard option A, which adds another $10,000 to the coverage. And they selected 5 times income, which is 375. So if you add all these up right here, they have a total of 500,000. And then they have this extra stuff, but this is actually for accidental death. So if it's like if it's an illness, then they don't get this extra 75, 77 or 10 or 87.
Just a note on the extra benefit.
Yep.
So that extra benefit is actually another time's salary, but it's a decreasing term. So and then once you reach, I think it's age 45, it goes to 0. So the reason that's not their full salary is because it's decreasing down. It hasn't reached the 0 point yet.
You're talking about the extra benefit, right?
Yeah, just the extra benefit.
This $38,500
Yeah.
that has no cost. You can see right here it says no cost. What
Right.
Allison was basically saying is this right here, right? So at the age of 40, that extra benefit is 38,500. Then it goes down to 30, 23, 15, 7, and at 45 it's down to 0. So that total basic life insurance coverage went from 115,000 all the way to 77,000 between the ages of 40 and 45. Okay. And every one of these policies with FEGLI, by the time you get 45, that extra benefit is gone. Okay. So that's what she means by decreasing coverage. Yeah. Now that $10,000 coverage that you saw on there, the option A, it goes up also with time, right? So between the ages of 40 to 44, it's 30 cents, and then 60, $1, and it goes up in 5-year increments. Okay, so the older you get, the more you're paying for this insurance. So in the beginning, it might be very low when you compare it to what we can offer them, but as they keep it, then you'll see the difference at the end, and we'll show you a calculation of what that looks like. The 5 times income is the same, right? Between the ages of 40 and 44, they're paying $11.25 per pay period, and then 22, 37, 67. So 150. Imagine you're 60 years old and now you're getting charged 150 per pay period. You're paying $300 a month for that insurance. Okay, and people normally work in the government until they can't work anymore, so it's not unreasonable to think that they'll be in their mid 60s, late 60s, and now their insurance is 180 per pay period. It's $360.
Hmm.
You see that? So it's a cost that keeps going up every. This is a comparison of a 40-year-old, and you have three comparisons. This is a Fagley versus Primerica with a preferred rating versus Primerica with a standard rating. And what you're going to see here is at 40, that premium goes from 24 to 49 to 81 to 146 to 325 to 390 over here by the time they're 65. Okay. So if you add it all up between the ages of 40 and 65, this person is going to end up paying a total of $42,217 a month. Okay.
Sorry, we're not seeing the screen.
Oh, you're not?
No.
We see it, Miss Ida.
Oh, okay, okay.
Yeah,
I
I
was
see the
like,
screen.
okay.
You
Phew.
might have
I
to,
mean, like the application itself?
No, you're
No.
not looking at the application. He's showing you a table comparing.
Yeah, I'm showing
like
you. I'm showing you the table.
I don't see the
Please.
table. That's okay. Go ahead, continue.
Yeah, the table is there.
Yeah, okay, table is there. So I'm gonna write. Tell me if you can see my writing. So this right here, you see that, Ida?
No. I only see your face.
Wow.
Well, there's an option.
You
There's
have
an
to
option. You
change to
have to.
speaker.
Yeah, there's an option you have to press
Like
so
a,
that you can see.
Okay, please continue. That's fine. I will look.
Okay, gotcha.
At the top, there's two tabs. Select the tab that says his screen and not meeting.
yeah.
Okay.
yeah.
Awesome. Okay, so everybody else can see this, right? $42,000 they're going to end up spending from the age of 40 to 65. Primerica preferred rate is $47 throughout, so they'll end up investing a total of $14,000, which is a $27,000 savings,
It's amazing.
right? And
Yeah.
this is like best case scenario. Not everybody qualifies for that. Let's say like the most normal case is that they don't qualify as preferred, but they qualify like a standard. So what you're looking at is okay, you have a 40-year-old that is paying, let's say, $24 a month. Okay. And with us, standard rate, what's the rate? Do you see that there?
72.
$72. So it's like, oh man, like we're coming in way higher. Maybe we should just leave them where they're at. If you don't know how Fagley works, maybe, right? But now that you plugged into our training tonight, you know that Fagley goes up every 5-year increments, right? So what you want to do is you don't want to compare it based on how much they're paying now. You're gonna quantify this out, what they're gonna pay through the life of the policy until retirement age. Do you see that? And yes, although right now we're coming up more, but ours is gonna stay until age of 65. So at the end, while they would have paid 42,000, well, that's going to be 22,000. We still save them about $20,000. So now how are we looking, Wilbur?
Very good.
That looks good. It's
We're looking
good.
better
It's-
now, right?
Yep.
But if you don't know how Fagley works, then you're going to walk away from the table, and long term, who's going to end up being hurt?
They are.
They're going to end up overspending on insurance, right? So that's why you have to get good at your craft, and especially us that are here in the DC metro area. A lot of us are in this area. A lot of people have these type policies through the government. So I would encourage you to go to is it fagley.gov, Allison? I believe it is.
Oh,
Your meeting?
yeah. I
Yeah.
usually just Google Fagley calculator, but yeah, I think it's fagley.gov.
Google Fagley calculator,
Yeah.
FEGLI calculator, and then play around with those numbers, right? Play around with those numbers before you have to sit with a client. Like go to the calculator if you can today, and then you can input numbers, and you can look at these charts, and you can see those numbers so that when you sit with a client, you kind of have an idea of how it works. Okay. So that is Fagley. Now, Primerica product is totally unique. Why are we unique? Because we offer terms of 10 all the way through to 35 years. Most companies, they don't offer 35 years. Like a lot of companies I've seen, they max out at 20. Some do 25, 30, but I'm not saying that there aren't, but I haven't seen any others that do 35-year terms, right? I mean, if you're talking to a 25-year-old, they might need it for 35 years, right? So we're one of the very, very few that offers a 35-year fixed term. And another thing is our pricing is based on the actual age versus attained age. Other companies price clients based on the closest closest 6-month birthday. So basically what that means is if somebody's applying for insurance today is the 3rd of December, I think, and their birthday is like the 1st of March, that's 3 months away, right? So since it's within 6 months, if you're talking to a 30-year-old, the insurance company is going to charge them the age of 31 because they're within that 6-month period of their next birthday. And that's how they mostly do it. With us, it's okay. You're 30 years old today. You qualify today. You're going to be 30 years old as your insurance age. Does that make sense? Also, our annual premium is divided by 12. Our annual premium divided by 12 is our monthly premium. There's no extra surcharges. Okay. So whether you pay it yearly or quarterly or whatever, it's going to be the same rate. Okay. So that's a little bit on pricing. The power of banding. How many of you guys go to Costco and buy in bulk? Like if you have, especially if you have a family, right? I mean, it pays to get the toilet paper and the tissues and all that kind of stuff versus going to CVS and you pay like through the nose for one box. So, it's 5 cans, 11 cans. We usually buy in half a dozen, right? 6, 12, or 24. So what that means is if you're talking to a client, okay, and you're quoting them and their need says that they need 140,000, a lot of times, actually always, you're better off giving them 150,000 than 140,000. So these are the levels at which you get discounts. You get discounts at 150, 250, 500,000, and 750,000. Okay, so keep that in mind whenever you run a needs calculation, and the needs calculation is like close to those levels right there. Most of the time, the quick quote will tell you, it'll give you an alert at the bottom. It'll say there's a unique banding opportunity, consider increasing it. So if you're close to those numbers that you see right there, then you can up it and you can give them more coverage for less money. Okay. And this is cool. Over here at the top, it says the only term product in the industry with banding, allowing us to combine 10, 15, 20, 25, 30, 35-year term policies, all in one policy, accomplishing banded discounts with only one policy fee. So what does that mean? What does that mean? That means that we have something called the custom term, right? And maybe a client has different needs, right? So maybe they need about $100,000 for their kid's college, but they might only need that $100,000 for, let's say, 15 years. You see that? And then maybe they have a mortgage that they owe $400,000 on the mortgage, and they just bought the house. So they might need that coverage for 30 years. Okay. So all of a sudden you can give them a total of $500,000 in coverage under one policy. You do a 15-year and a 30-year, and you add both of these up, it's 500. So they've qualified for a band under different term levels. So instead of selling them different policies, you have one policy that gives you kind of two coverages in one. And because it adds up to the 500, then that gives them, that more coverage. And then guess what happens at the 15-year mark? Once the kids are out of college, you don't need that coverage anymore. Then the insurance drops. Okay, that's the idea of custom. I mean, you can band coverages for different needs, and you can, help them qualify for higher amounts at a lower price. And it's not like different policy fees. How awesome is that?
Awesome.
Now check this out. Terminal illness benefit. Anybody know what terminal illness benefit is?
No.
So somebody might have the cheapest, but the cheapest isn't necessarily the best. I like this example that they give, right? It's like, is the TV with the best picture and the best price, but has no sound? Is it the best TV?
No.
No. Like, what do you do with a TV that has no sound? You know, it's like, okay, that's no good. So just because someone has the cheapest term, does it make it the best?
No.
Not necessarily. You have to take a look at things like terminal illness benefit. Does your policy have it or not? What is a terminal illness benefit? Okay. It says a term insurance policy without the terminal illness benefit is not the best life insurance policy. So basically what you're looking at is, you know, some people have a history in their family of, you know, heart disease or cancer, etc. Okay. So in those, is a lot of that stuff is genetic, so there might be a possibility that maybe you might have that. And our policy has something called a terminal illness benefit. Basically, if you're diagnosed with something terminal where you have maybe like 6 months or less to live, they can actually give you 40% of the face amount or up to 70% of your face amount if you have a waiver of premium. The maximum you can have is $400,000 up front. Okay. So what that means is, like, if you had a $1 million policy, you can have up to $400,000 that they can give you for maybe treatment, right? Like, let's say you had like some rare illness and maybe like all approved FDA treatments aren't working, but you might want to try something experimental, but then your health insurance won't cover any experimental treatments. And maybe those experimental treatments might be like $20,000 a month, and you don't have that $20,000 a month. What are your options? You have no options. Now you're just waiting to die, right? If you have a terminal illness benefit, now all of a sudden you have, in this example, $400,000 you can use. We actually have a couple, Sandy Azapovic and Mark. She was diagnosed with a very aggressive form of cancer, and there's a lot of Primerica people have gone to this treatment center out in Arizona. Costs like $20,000 a month. Not a lot of people have that kind of money. All of a sudden, if you have this benefit, I mean, this was over 20 years ago. She's still with us today, right? Because of access to these type of benefits, right? What kind of a price do you put on something like that, right? That could extend your life possibly for 10, 20 years, right? So that's the terminal illness benefit. And then the other thing is the renewal options. You know, a lot of these policies, when you renew them, as you saw with that other policy that I showed you earlier, it went from $53 to like $600 a month. So we have industry leading rates. It says at least 80% less cost than anybody else. Also, it's the only term product in the nation that can convert to decreasing term with level pricing to age 100. So basically, you can keep your same insurance premium, Miss Matilda, until the age of it says 100, right?
That's right.
So the only term to term conversion in the industry. All of these other companies, they are just dying for you to convert over to permanent insurance. They want you to get that whole life insurance policy, right? They'll only offer term insurance just to get you in the door, and then they want to convert you. I was talking to a client this week. Okay, I have a follow-up with them, and she's like, "We have insurance already," but she's like, "But I'm not really happy with them. They keep calling me every single year, and they keep bugging me. I keep telling them I'm happy with what I have, and they keep bugging me about converting." So she's like, "I don't want to deal with them anymore." Yeah, what are they trying to do? We know. They're trying to do one of these things. The competition has two horrible options. One is outrageously high rates that you just saw on the other policy, and the other one is to convert them to a whole life or cash value insurance, which is also going to be more expensive. It's going to give them too little coverage, okay? And both options are far too expensive for most families, right?
Right.
Check this out. This is a State Farm policy. Select 20-year term, male age 33, female age 32. They're paying a total of $138 a month. He has 1.5 million of coverage. She has 1.2 million of coverage. He's preferred and she's super preferred. $138 a month. Okay. But what's going to happen after 20 years is going to renew, and then it's going to increase, and it's going to go from $138 to
Uh-oh.
55,000 by the 30-year mark, right? So the premiums are going to go from 1660 to 55,000. Who can afford payments of $4,000 plus a month?
Jesus.
Difficult.
Nobody.
No, they're not going to be able to. It's incredibly unaffordable. Okay. So whenever you talk to somebody that has term insurance, you want to ask for their policy so you can do a detailed comparison. You want to look at these tables. You want to look at what the cost is going to be. And then you can do a comparison of what our cost versus their cost. Okay. So there you have it, from 16 to 55,000. So this is what it looks like, right? You see that green line right there? This is like when this person got the policy, they had $1 million coverage and they had it for 20 years. And then all of a sudden at the 20-year mark, maybe they thought they needed coverage. They wouldn't need coverage after 20 years, but life is life and things change. Maybe all of a sudden they have a need beyond the 20 years that they didn't think they would have. Right? So all of a sudden you're 20 years in and now your insurance is costing you, to renew it, $4,000 a month. You can't renew it. It's too much money. And a lot of times you have to go through reinsurability to be able to qualify. So you go from $1 million in coverage to zero. And you have a problem. You see that blue shaded area? That blue shaded area means that you still have a need for insurance for the next maybe 10 or 15 years, but you can't afford the insurance anymore. So you went from $1 million to zero. That's a problem.
Yeah.
Okay. Now let's take a look at what it would look like with Primerica. So you can actually design it in a way where, let's say 20 years go by and they still have a need for insurance right at that 20-year mark. Let me see if I can. Yep, I can. Right here. Okay. You still have a need for insurance at the 20-year mark, and you can actually design it so where the need for insurance, you can renew it, and you can have like a decreasing term to the age of 95. Okay. And a lot of times you can, and you can maintain the same premium payment that they were paying throughout the life of the policy. Okay, so it just gives you an option of being able to renew it at the end and keeping the same premium. Does that make sense? All right. Now, 100% of the time, Primerica is the best option for your client. It will always cost less over time, the total time the client needs the insurance. Okay. There's two costs in life insurance: the upfront premium, which is the one that, the $72 a month or the $100 a month, whatever that is for that term. And then the renewal premium to keep the coverage in duration, right? So what are they going to pay at the end of the term, and how much is it going to cost them for those extra 10 years versus what ours would be? Okay. You always want to compete on total cost basis. Okay. Like you saw in the Fagley, right? $72 a month versus 25. But if you calculate it out over the life of that 40-year-old, from 40 to 65, we're going to save him $20,000. You want to do those comparisons so you can see what the total cost is going to be at the end. Does that make sense?
Yeah.
That's why Christian's always like, did you get the policy from the client that had the insurance? And then he's like, you didn't? Like, that's malpractice, right? You're not doing the best job for the client. So always ask for the policy if they have a policy so you can do the numbers. Otherwise, they're also going to have the other agent come by and he's going to say, they didn't even see the policy and they told you to make a change. Not professional. So there's three scenarios. You have a scenario where we're the cheapest up front, right? If we're the cheapest up front, we're always going to be the cheapest on the back end because you can keep the same premium until the age of 95. You have the one where they need insurance for more time than they have on their term, okay? And I want you to pay attention to this phraseology, okay? Coming up. And then you have the option where they won't need insurance at the end of the term. Okay. So in scenario one, this is the most common sense option, right? So they have insurance and theirs is $70, and with us it's $50. All right. Well, we're giving them the same coverage for less money. Take the application because it's in their best interest. Does that make sense?
Yeah.
That's
Yes.
scenario A. Scenario B is maybe with us more money up front beyond the term. Okay, so maybe after the 20 years, they might still need coverage. So check this phraseology out. Okay, you would say, Mr. and Mrs. Client, are you 100% positive beyond any shadow of a doubt that you won't need $1 of this life insurance in 20 years, in 30 years? Okay, most of the time, if you ask that, they'll be like, I mean, I'm not 100% positive. There might still be a need after the 20 years. We don't think we'll need it, but there might be a possibility, right? And now you have their table. Now you see that their cost there is going to be way more. If no, like we're not 100% sure, then you're going to ask something like this. Are you going to pay this premium when it comes due? Are you going to pay this $55,000 a year when it comes due? No, you can't afford that. Then, if I could get you a policy that's similar in cost, but lets you keep substantial coverage beyond the term with no health check and no premium increases, that would solve that problem. Wouldn't you agree? What's the problem that we're referring to?
Increase of the
Cost
premium.
to maintain the insurance after the term is ended.
Yeah, that's a big problem, right? Like you can't afford $55,000 at the end.
Yeah.
So if we can get you a policy that's going to be similar in cost, okay, and it lets you keep a substantial amount, because with ours, does it require reinsurability? Do you have to qualify again at the end of the term, or can you keep that coverage at the end of the term?
Keep-
You can keep it,
it.
no questions asked. Even if you're on your deathbed, you can keep that coverage, no questions asked. Okay. And no premium increases, right? You might have to reduce the coverage, right? But you can keep the same premium. Unlike a lot of companies out there where you'll have to go through reinsurability, and if you're like terminal cancer, are they going to reinsure you?
No.
No. You paid 30 years and now you're going to get nothing, and you're at the end of the line.
Yeah.
Terrible. So that's what this graphic is right here. This is, under normal circumstances, you went from $1 million in coverage to 0 in coverage because you can't afford those $55,000 a year premiums. And with us, you actually would have the option of, decreasing it to an amount that you can afford, and then have decreasing term to 95 and always keep the same premium that you were paying throughout the life of your policy. So it just gives you more flexibility. Does that make sense? Awesome. I guess it's making sense.
Makes a lot of sense.
Awesome.
Yes.
And this is the same thing, right? Is there anything different about this one than the last one? I think it's the same.
No, this is the same, it looks like.
Yeah,
Yeah,
it looks like,
it's the same. It just says, hey, we got the need is there, so we can keep the need fulfilled. What's the next one show? Because otherwise current it drops. Yeah.
take an app, right? Take an app. So if we come in lower up front, take the app. If they might have a need beyond that term and they can't afford to pay those renewal rates, and you show them all the stuff and you ask that question that we went over, then take an app also. Now, if the client says, no, Gordon, I absolutely won't need any more coverage after the 20 years, this is rare, but we have a solution. And then I'm thinking what this is like, would this be like custom term, Gordon?
Yeah, custom term, decreasing term, where you meet with them and you just decrease it based on their need at that time.
Right. Because their need for insurance will not be $1 million for the full 20 years, right? So remember the example I gave you earlier, you have a kid that has $100,000 for college, you might do a 15-year term. So it'll go down according to their specific needs, and then at every interval it's coming down in cost. So they're getting the same amount of coverage, and it'll go down with the responsibilities. So they're gonna be spending less and less and less money for that coverage. Right. So those are the scenarios. Here's another thing. And this phraseology is really important. If I can get you a policy that more accurately reflects your need for life insurance and costs less than you're currently paying, would you make a switch? Or would you like to continue paying for coverage that you don't need?
No.
This is the idea of having $1 million for 20 years when you might not need it for 20 years. So you're overpaying for that. When with us, you can have the amount you need, as you go along. So that's that decreasing term coverage that you see right there, right? So the need goes down, so then your insurance coverage goes down. Just to kind of reiterate, maybe at this point you have a mortgage, and then you have kids, and then maybe you have some car loans and some debt. You do a debt snowball, you can get them out in less time. So you can structure it so maybe like some coverage is for 15 years, some coverage is for 30 years, some coverage is for 20 years. And as they go through life and their responsibilities decrease, kids are out of the house, debt is paid off, mortgage is paid off, then you're decreasing the coverage and you're decreasing the cost. So it's customized to your situation. I don't think there's any other companies that do that out there. I haven't seen it. Okay. Child rider. Where are we at with time? Okay.
19, we're good.
We're good. Okay. So child rider, there's 3 reasons why every policy should have a child rider. Funeral expenses are very high now. I just had a client whose son passed away in August. He was 24 years old. And yesterday would have been his 25th birthday. And they ended up spending somewhere around $20,000 for the funeral, right? So imagine going through a loss and then you have to come up with the money. Okay. And this second one is really, really important. It says time to mourn. We have a policy that gives coverage up to $50,000 on the child rider. So imagine like you burying your child and then you having to go back to work the next day. I mean, that's the reality for most people.
It's
Yeah.
sad. Yeah,
If you had a coverage of, let's say, $50,000, maybe the funeral will cost you 20, and then you have $30,000 that now you can take time to really grieve privately and appropriately. You don't have to rush back to work because you have bills to pay. Right? That's the idea of if they can afford it and if it's appropriate, you can go up to $50,000 in coverage, and that would give them the flexibility of not only covering those expenses, but giving them some money, extra money, so they have time to grieve that loss. Okay. And then once the child turns 25, whatever coverage they had as a child, they can 5 times that coverage without any going through any medical questions. I had a client who 2 of his kids, they had cancer when they were children. And one of them passed away at 25 years old. The other one had cancer at 11 years old, recovered, and he can continue that coverage despite the fact that he had cancer and he was a survivor.
Wow.
Okay, with that child coverage that he's able to convert. Okay, so that's why I always add child riders to every policy, because you never know. I usually don't even make it an option. I just add it on there. I'll just tell them it's going to be this much.
So if you have a client base or you have any, would it be a good idea to maybe go back and look over policies and see if they have kids and check in? And it's an opportunity. I mean, and add child riders.
Yeah, you can definitely do that. You can go to active policies. You can see who has a child rider, who doesn't have a child rider. You can use these stories that we cover in training, right? Yeah, a colleague of mine, their son died at the house. He was 24 years old. They weren't expecting it. It's $20,000 in funeral costs.
Well, we had a colleague in our office on our team lost a
Yep.
son this summer, and
Yep.
thank God we had 15 on him, but 15 wasn't really enough.
Nope. Nope. I used to put 15,000 child rider. Now I put 25,000 because the last few clients that I've had, they've been spending about that amount of money on funeral expenses. So now everybody gets 25,000.
I would say that needs to be across the board. We all should really adopt that because I've had multiple people come back to me and tell me I paid a $15,000 claim 2 weeks ago. It was for Spanish family. They only put 15 on mom and dad.
Mm-hmm.
He died. And so 15,000 wasn't enough. They spent like 25,000. So they had to come out of pocket.
Mm-hmm. That's right. No war or terror clause. So a lot of policies they have in the fine print that that if there's any kind of like they have a war exclusion, right? So if we're attacked from somebody, some a terrorist or something, they might not cover that loss. So some of you were around, some of you were not around back in 9/11. When we got hit by the terrorist attacks.
Yeah, we were around.
You were around, yeah. Matilda, I know you were around, Matilda. I was
That's right.
around.
Young people.
So there's a lot of companies that did not want to pay out their benefits because they were trying to kind of say, oh, it was an act of terror, right? The president went on TV and said it was a terror attack, so we're not gonna pay out. And eventually, the government stepped in and they kind of forced their hand. But Primerica was one of the first companies that they didn't make any excuses. They're like one of the first companies that came out and they paid all the benefits without having to have our hand twisted when it came to that. Okay. It says,
Hector, can I make a simple comment?
yeah.
Yeah, when COVID came, they considered it also as an act of war. So some companies wrote letters that they were not going to cover their policy owners that had COVID. They didn't pay, but Primerica paid all the COVID debt.
Wow.
Yeah. Oh yeah, that's it.
In the billion. America pay a lot of money.
So check that. I mean, I didn't know that.
Yeah. We actually saw a letter written by, maybe I don't want to mention the name, but they wrote letters that they were not going to cover people that had COVID. Yeah.
Wow. Okay. So you see that little box is casualties of war on terrorism since 2001 in Iraq and Afghanistan, 116,000 civilians who were at risk of not having any benefits paid out because of a lot of these companies have the war and terror clause. And July 20th closing life. I don't know what that means, but maybe
that needed to be taken out, I guess.
Okay, gotcha. Okay. So there you go. That's a little bit about life, Primerica life insurance, some features, benefits. You learned a little bit about FAGLI, you learned a little bit about renewal rates, you learned a little bit about custom advantage, custom term insurance, and some other things. So I'll open it up to any questions that you guys have. I saw Damina raising her hand.
Yes. Sorry. For the child's rider, when the child turns 25, it can be it can go up to 5 times up to 125.
Yeah, if they have 50,000.
What if they need more than that? Would it just be another?
So then you can do a new policy.
They just have to medically qualify for the additional amount above and beyond 125.
Yeah. I met with a client on Saturday, and it was one of those situations, Damina, where he was coming up on so when they turn 25, they still give you like 30 days after they turn 25 for you to opt in, I guess. Is that still the case? Do you guys know? Like after they turn 25, I think they give you like another 30 days beyond that. So he had already turned 25, and they sent him a letter saying these are your options. If you want to continue the 15,000, it'll be this much, and then it's like 30,000, 50, they give the options. And then you can remember we did the banding is at 150 and 250. So I always show them the first banding, which is 150,000. So a lot of times it's better to have 150,000 than like 75,000.
Mm.
Yeah.
So the 125K is with no proof of insurability.
No proof of insurability.
The 35-year term now,
35-year term now, no insurability.
or
Yeah.
power term, or whatever the thing is now.
So it used to be like you can add child riders up until they were the age of 25 before. Now, if they're 18, you cannot add them as child riders. But if they have been added before the age of 18 under the policy, then they're going to be on there until 25.
Very good.
Yeah, that's another point there. All right, I think we covered all
Hey,
of those.
Hector,
Yeah.
can you explain why the premium rate is better at those banding marks? Like I understand that it's better like 150 or 250, but what's the reason for it?
I don't know. I don't know why that is. I just know that at those marks they give you a discount. Yeah. I don't know if anybody else here knows the answer to that.
Gordon, you want to cover that?
Well, I think there's some of that. I would agree with Hector. I don't know exactly why they picked 150, 250, 500. My assumption would be, and it's industry standard, and it could be the way that they reinsure, Bernie, because what happens is our company doesn't take on all of this on their own liability. So they'll wrap up a package and they'll have other insurance companies come along. And this is industry standard. Other companies come in and they'll say, hey, you've got this big book of business. Here's all the clients 150 and below. Here's all the clients 250 and below. Here's all the clients 500 and below. And they'll have these companies reinsure based on that. And that's the only thing I can kind of tell you is, but I'm not, that's not, that's kind of back office side of the business. I've never been involved with it, but I do know from talking to people at home office that most companies, a large percentage of their coverage is reinsurance companies who you don't even know who they are. And they get a part of the profits. They get that's part of their risk factor. They get some of the profit and then they get some of the risk.
Yeah.
Does that help?
Okay. Yeah. Thank you.
But it's really important for us to know it, because you don't want to be writing coverage just underneath that. And it does flag it because it's better for the client to try to get them to that coverage amount.
Yeah.
Yeah.
True.
Thank you.
Good question. Good to see you, Bernie.
Yes, sir. Good to be here.
Any other questions? All right.